The unique three-river is a bullish reversal pattern that emerges in a downtrend, indicating a potential shift in market sentiment from bearish to bullish. This pattern consists of three key candlesticks that signal a change in investor outlook, leading to a possible uptrend. To understand and chart the course with the unique three-river pattern, one must closely observe these three candlesticks and their positioning within the market trend. Firstly, the setup begins with a long bearish candlestick that reflects the continuation of the downtrend. This candlestick is followed by a smaller candle that typically opens lower but closes within the range of the prior candlestick, hinting at a weakening of the downtrend momentum. The third candlestick is crucial as it opens within the body of the second candle but closes significantly higher, often within the range of the first candle, providing a clear signal of buying pressure and a potential reversal in trend. For investors and traders, recognizing the unique three-river pattern becomes a vital skill in predicting market shifts. By identifying this pattern, one can make informed decisions regarding entry and exit points in their trading strategies. It's important to note that while this pattern signals a potential change, it should not be relied upon in isolation. Combining its analysis with other indicators and considering the broader market context can enhance decision-making and increase the chances of success in navigating market changes. The upside Tasuki gap is a continuation pattern observed within an uptrend in the financial markets. It signifies that the current trend is likely to continue. This pattern involves three main bars on a price chart. Initially, there are two consecutive green bars, each closing higher than the previous day, which is indicative of a strong uptrend. The third bar then opens within the body of the second bar but does not close the gap, and it might close higher or lower within the gap between the first and second bars. This incomplete closure of the gap signals that buying interest remains potent despite the market taking a breather, thus suggesting a likelihood of the uptrend's continuation. Understanding this pattern can assist investors in making informed decisions by anticipating the possible continuation of an uptrend and adjusting their strategies accordingly. Identifying the upside Tasuki gap involves recognizing a specific pattern within an uptrend in the stock market. This pattern emerges over 3 days during which the stock market experiences a continuous upward trajectory. On the first day, we see a long white candlestick, which signifies a significant increase in the stock's price from the opening to the closing bell. The white color indicates that the closing price was higher than the opening price. Following this, on the second day, the market opens higher than the previous day's close, creating a gap. This day also closes higher, represented by another long white candlestick. It is crucial to note that there is no overlap between the bodies of the first and second day's candlesticks, which is what forms the gap characteristic of this pattern. On the third day, however, the pattern takes a slight turn. The market opens within the body of the second day's candlestick, but closes in the gap between the first and second days without closing the gap entirely. This day's candlestick is usually smaller and can be either black or white. Black indicates that the closing price was lower than the opening price, while white represents a higher closing price. The upside Tasuki gap is seen as a bullish continuation pattern, suggesting that the prevailing uptrend will continue. Investors and traders view this pattern as an opportunity to either enter new positions or hold onto existing ones in anticipation of a continued upward movement in price. Understanding this pattern requires an eye for detail and familiarity with candlestick chart patterns, making it accessible to those who have spent some time observing and studying market charts. The upside Tasuki gap is a continuation pattern observed in an uptrend, which offers insights into market sentiment. This pattern emerges during a period of bullish market sentiment and is characterized by a specific sequence in candlestick charts. To begin, the pattern involves 3 key candlesticks. The first candlestick is long and green, indicating strong buying interest. Following this, there is a gap upwards where the second candlestick, also green, opens higher than the previous close, reinforcing the bullish sentiment. The third candlestick is where the pattern is truly identified. It is a red candlestick that opens within the body of the second day and closes within the gap between the first and second days. However, it is crucial to note that the third candlestick does not close the gap entirely. This third candlestick is significant as it hints at some selling pressure, but not enough to reverse the trend. The gap that remains unfilled serves as a testament to the prevailing upward momentum, suggesting that while there may be a momentary pause or slight pullback in the trend, the overall market sentiment remains bullish. In deciphering market sentiment, the upside Tasuki gap is valuable. It indicates that despite momentary hesitations, which could be due to investors taking profits or a slight increase in selling pressure, the demand for the asset remains robust enough to sustain the upward trend. This pattern thus serves as a confirmation for traders and investors that the current uptrend is likely to continue. Recognizing such patterns helps in making informed decisions about entering or maintaining positions in the market, guided by a clear reading of the prevailing sentiment. In summary, the upside Tasuki gap is a bullish continuation pattern that signals persistent buyer interest and positive market sentiment, highlighting an opportunity for traders to capitalize on the continuing uptrend. The upside Tasuki gap is a pattern found in the charts of financial markets, indicating a continuation of an existing uptrend. This pattern emerges during a strong upward trend and is characterized by a specific formation in the price candles or bars on the chart. To understand this pattern, imagine a scenario in the market where buyers are in control, pushing prices higher. On the first day of the pattern, we see a large candle indicating a significant price increase, a sign that buyers are firmly in command. The following day, the market opens higher than the previous day's close, creating a gap. This gap is crucial because it signals continued buying interest and optimism among traders. However, on the third day, something interesting happens. The market opens within the body of the second day's candle but does not close the gap. Instead, it closes higher than its open, but still within the range of the second day's candle. This day is crucial because, despite the seller's attempts to push the price down and close the gap, the buyers maintain enough control to keep the price up by the end of the trading session. The upside Tasuki gap serves as a signpost indicating that the uptrend is likely to continue. Traders and investors view this pattern as an opportunity to join the trend, expecting that the bullish sentiment in the market will persist. It's like spotting a train that has momentarily slowed but is likely to speed up again. The Tasuki gap tells investors it might be a good time to get on board. In summary, the upside Tasuki gap is seen as a bullish continuation pattern that suggests an ongoing uptrend is likely to persist. Its identification on a chart can be a signal for traders and investors to consider maintaining or initiating long positions in anticipation of further upward movement. Confirming the signal of an upside Tasuki gap, a continuation pattern in an uptrend, involves observing certain market conditions and candlestick formations. Initially, you would see a gap between two bullish candlesticks in an upward trend. This gap is an indication that buyers are dominating the market, pushing prices higher. To confirm this pattern's signal for continuation of the uptrend, the next step is crucial. Look for a third candlestick that opens within the body of the second candlestick but does not close the gap. Instead, it partially enters the gap but ends the session with a closing price above its opening price. This formation signals that despite a slight pullback, the buyers retain control, suggesting that the overall bullish trend is likely to continue. Market participants often view this confirmation as an opportunity to join the prevailing trend with an expectation of upward price movement. Understanding and identifying this pattern requires careful observation of candlestick formations within the context of the existing market trend. The upside Tasuki gap is a pattern seen in technical analysis that indicates a continuation in the upward trend of a market. It forms during a solid uptrend when there is a gap followed by a candlestick that does not fully close the gap. This setup suggests that the bullish momentum is still strong and that the uptrend is likely to continue. Regarding the reliability of the signal, it is important to consider a few aspects. First, like all technical patterns, the upside Tasuki gap does not guarantee the continuation of an uptrend, but indicates the possibility based on past market behavior. Its reliability can be influenced by market conditions, including volume and the presence of other confirming signals. To increase confidence in this pattern, investors often look for high trading volume during the formation of the gap and the following candlesticks. This high volume indicates strong buyer interest and increases the likelihood that the trend will continue. Additionally, confirmation from other technical indicators or patterns can further strengthen the reliability of the upside Tasuki gap as a continuation signal. In summary, while the upside Tasuki gap is a bullish signal in an upward trend, its reliability can be improved by considering the trading volume and seeking confirmation from additional technical analysis tools. Investors should use this pattern as part of a comprehensive trading strategy that accounts for multiple factors to make informed decisions. The upside Tasuki gap is a pattern found in financial charts that signals the continuation of an existing uptrend. This pattern forms when there is a gap between two bullish candles, followed by a third candle that opens within the body of the second candle but does not close the gap. It suggests that the upward momentum in the market is likely to continue. When integrating the upside Tasuki gap into technical analysis, it works best in synergy with other technical analysis tools. For instance, combining this pattern with volume indicators can enhance the reliability of the signal. High trading volumes during the formation of the upside Tasuki gap reinforce the strength of the ongoing trend. Meanwhile, moving averages can be used to confirm the overall direction of the market. If the pattern forms above a moving average, it further confirms the bullish sentiment. Additionally, momentum indicators like the Relative Strength Index or RSI can be employed to verify if the asset is not entering overbought territory, which might signal a potential pullback or pause in the uptrend. This comprehensive approach using the upside Tasuki gap in conjunction with other technical analysis tools enables traders to make more informed decisions based on a fuller understanding of market dynamics. In the context of the upside Tasuki gap, which is a continuation pattern observed in an uptrending market, it's essential to keep in mind some strategies to navigate potential pitfalls. First, the upside Tasuki gap happens when there is a gap between two consecutive candles, indicating strong buying pressure. However, this pattern must be approached with critical analysis to ensure it isn't misinterpreted due to market volatility or other factors that could lead to false signals. One key strategy for avoiding these pitfalls is to look for confirmation. After identifying a potential upside Tasuki gap, investors should wait for the next candle or trading session to confirm that the uptrend is likely to continue. This could be in the form of a new high or additional price action that supports the continuation of the uptrend. Another essential aspect is to set appropriate stop-loss orders. Given that no pattern provides 100% certainty, setting a stop-loss slightly below the gap can help mitigate risks if the market reverses unexpectedly. Lastly, it's crucial to consider overall market conditions and not rely solely on pattern recognition. The effectiveness of chart patterns, including the upside Tasuki gap, can be influenced by external factors such as economic news, changes in interest rates, or global events. Therefore, integrating fundamental analysis with chart pattern recognition can provide a more comprehensive view, enabling investors to navigate potential pitfalls more effectively. By approaching the upside Tasuki gap with a combination of confirmation, risk management, and broader market analysis, investors can utilize this pattern to make more informed decisions in an uptrending market. The upside Tasuki gap is recognized as a continuation pattern found in an upward market trend, signifying the potential continuation of that trend. In the strategic applications of this pattern, traders and investors look for specific formations in the price charts to make informed decisions. To begin with, this pattern forms when there is a gap followed by a candlestick that partially fills that gap, yet does not completely cover it. This gap and the subsequent candlestick are crucial as they confirm the ongoing bullish sentiment in the market. Therefore, an understanding of this pattern provides strategic insight into whether the upward trend is likely to continue. To utilize the upside Tasuki gap effectively, investors and traders monitor for the initial gap that signals a strong buying interest, followed by a candlestick that opens within the body of the previous day's candlestick but does not close the gap entirely. This indicates that while there is some selling pressure, the buying interest remains strong enough to sustain the uptrend. Strategic application involves entering long positions or buying when this pattern is identified, as it suggests that the upward momentum is likely to persist. However, it is essential for anyone applying this strategy to also consider other market factors and indicators to support their decision, as relying solely on a single pattern can be risky. In essence, the upside Tasuki gap serves as a signpost for those with a keen eye on the markets, directing traders and investors towards opportunities where the continuation of an upward trend is anticipated. By providing a clear visual cue, this pattern helps simplify complex market dynamics into actionable insights, allowing for informed decision-making in the pursuit of potential gains. The upside Tasuki gap is a technical analysis pattern that typically signifies the continuation of an existing uptrend in the market. This pattern is characterized by a situation where the market experiences a gap in trading prices between two consecutive days. Specifically, this gap happens when the lowest price of the second day is higher than the highest price of the first day, creating a noticeable gap on the chart. This phenomenon is typically observed with a backdrop of increasing trading volume, indicating strong buyer interest. Exploring the variations of this pattern helps in understanding its behavior in different market conditions. One such variation occurs when the gap is partially filled on the third day, yet the price does not close the gap entirely. This scenario suggests that while there might be some selling pressure, buyers are still dominantly in control, reinforcing the continuation of the uptrend. Another interesting variation to consider is when the gap is nearly filled or completely filled but followed by an increase in price, confirming that buyers have managed to overcome sellers' attempts to push the price down. This can be seen as a reassurance of the strength of the ongoing trend. It is essential for investors and traders to watch for these signs, as they can indicate potential investment opportunities. However, it is also crucial to combine this pattern analysis with other technical and fundamental analysis tools to make more informed trading decisions. Recognizing the variations of the upside Tasuki gap helps in refining the understanding of market sentiment and can provide a strategic advantage in anticipating market movements.